Okay, I will start with the definition of term loan. The term loan is a type of financing given by the financial institution, such as a commercial bank, development banks, and special institution for lending money. The borrower takes a lump sum amount and agrees to return the amount along with the interest. The whole amount is repaid within the stipulated time in installment, including both principal and interest. There is a processing fee as a cost to acquire this type of financing. Generally, the term loan is obtained for financing large expansion or diversification of an organization. The borrower has to submit his financial statement and his net worth capacity so that the lender can assess the ability of the borrower to pay back the loan or the assumption that the profit will increase over time. For raising a business supply capabilities, purchasing an asset, or for any expansion, the term loan is an easy option to arrange the finance quickly.
Types of term loan. So there are three types of term loans. First one is short-term loans. A short-term loan is a type of loan offered to the borrower for a duration of 12 to 18 months. Some lenders also give a tenure of 84 months. Business owners requiring immediate financial assistance avail short-term loans to fulfill their needs and repay the loans in a short amount of time. Examples of this type is overdrafts, line of credit, payday loans, trade credit, and bridge loans. Second type is intermediate term loans. Intermediate term loans or mid-term loans have a tenure longer than 84 months. These types of loans are useful for business with big budget financial needs, such as purchasing machinery, boosting working capital, and etc. Examples of this type are equipment financing, vehicle loans, and business expansion loans. The last type is long-term loans. Long-term loans have a tenure from anywhere between 3 years to 30 years, available at attractive interest rates and easy EMI rates. Long-term loans come with a lump sum funding, fulfilling all business requirements, and are easy to repay over the long tenure. Examples of these types are mortgage, business acquisition loans, infrastructure financing, and long-term business expansion loans.
So what are the advantage and disadvantage of term loan? First, I will discuss about the advantage first. Fixed repayment schedule. With a term loan, you will know exactly how much you need to pay each month, which can make it easier to budget and plan for the future. Fixed interest rate. The interest rate on a term loan is fixed, which means that it won't change over the course of the loan. This can make it easier to predict the total cost of the loan and plan for the future expenses. It also can be secured or unsecured. Term loans can be secured, meaning that you pledge collateral as security for the loan. This can help you get lower interest rate. However, even if you don't have collateral, you may still be able to get an unsecured term loan. It can also be used for a variety of purposes. Term loans can be used to finance a wide range of business expenses such as equipment purchase, expansions, and working capital. It also may be tax deductible. The interest paid on term loan may be tax deductible, which can help lower the overall cost of the loan. So now we will move on to the disadvantage of term loan. First one is the long repayment period. Term loans usually have a longer repayment period than other types of financing, such as short-term loans or credit card loans. This can mean that you will be paying on the loan for a longer period of time, which can be a burden if you have other financial obligations. It may require collateral. If you want to secure a lower interest rate on a term loan, you will need to pledge collateral as security for the loan. This can be risky if you are not able to make your payments, as the lender could seize the collateral if you default on the loan. It also may have higher interest rate. Unsecured term loans may have higher interest rates than secured term loans because the lender is taking on more risk. This can make the loan more expensive over time. It also may require a co-signer. Some lenders may require a co-signer if you don't have a strong credit history or if your business is new and does not have a track record of success. It also may have fees. Some term loans may have origination fees, prepayment penalties, or other fees that can add the overall cost of the loan. It also may require a personal guarantee. Some lenders may require a personal guarantee from the business owner, which means that you will be personally responsible for the loan if the business is unable to pay it back.
So for the next part is the loan agreement. A loan agreement is a formal contract outlining important counterparty information and responsibility as well as credit terms like the loan amount, the type of loan be extended, and the repayment schedule, and the interest rate. A loan agreement is made between the creditor or the lender and the borrower, the debtor. Although it is generally prepared by the lender's legal counsel in order to ensure the legal enforceability of the contract. A loan agreement may be called a number of different things, including a loan contract, a credit agreement, a financing agreement, and in some cases, a promissory note. Without a formal contract or the loan agreement to bind these parties together, there would be no legal recourse for one party should the other breach one or more of their respective obligation, and when an asset serves as a collateral to backstop credit exposure, the loan is said to be secured. Any collateral that will be served as a security for a loan is generally referenced in the loan contract. Although separate security agreements are often employed to register liens over specific serial number or legal property addresses.
The source and type of equipment financing. Source of financing are commercial banks, finance company, and sellers of equipment. Type of financing. The first one is chattel mortgage, a lien on specifically identified personal property, asset other than real estate backing a loan. To perfect, the lender files a copy of the security agreement or a financing statement with a public office of the state in which the equipment is located. The second is conditional sales contract, a means of financing provided by the sellers of equipment who holds title to it until the financing is paid off. The buyer signs a conditional sales contract, security agreement, to make an installment payment, usually a month or quarterly, over time. The seller has the authority to repossess the equipment if the buyer doesn't meet all the terms of the contract. The seller can sell the contract without the buyer's consent, usually to a finance company or a bank.
So the leasing definition. A lease is defined as a contract under which one party, the owner of the assets hereby called the lessor, provides the assets for the usage to another party or the lessee for the period of time known as the term of lease, which is mutually agreed upon by two parties and charges a consideration in the form of periodic lease rental payments for the assets. And the most important part is the lessor retains the ownership of the assets.
Type of leasing. First is the leverage leasing, a lease arrangement in which the lessor provides an equity portion, usually 20 to 40% of the lease assets cost, and third-party lenders provide the balance of the financing. Popular for big-ticket assets such as aircraft, oil rigs, and railway equipment. The role of the lessor changes as the lessor is borrowing funds itself to finance the lease for the lessee. Any residual value belongs to the lessor as well as any net cash inflows during the lease. The second is the sale and leaseback. The sale of an asset with the agreement to immediately lease it back for an extended period of time. The lessor realizes any residual value. There may be a tax advantage as land is not depreciable, but the entire lease payment is deductible expense. The lessors, such as insurance company, institutional investor, finance company, and independent companies. The third one is the direct leasing. Under the direct leasing, a firm acquires the use of an asset it did not previously own. The firm often leases an asset directly from a manufacturer. Example, IBM leases computers and Xerox leases copiers. Lessors, such as manufacturers, finance companies, banks, independent leasing companies, special purpose leasing companies, and partnership.
The next one is about the advantage of lease financing. First is the cost effective. One of the primary benefits of lease financing is its cost effectiveness. Instead of making a substantial initial investment to purchase an asset outright, your business can spread out the cost over the lease term. This approach allows you to allocate funds more efficiently, preserving capital for other essential operations or unexpected expenses. Second, no dilution of ownership. Lease financing stands out as it provides the necessary funds without requiring businesses to give out equity or control. This means that entrepreneurs can retain full ownership of company while assessing the assets they need. In contrast, other financing methods might require giving up a stake in the business, potentially diluting the business owner's control and decision-making power. Third is the flexibility. The dynamic nature of the business world means that assets can become obsolete quickly. With lease financing, the risk of asset obsolescence is borne by the lessor. This arrangement provides businesses with the flexibility to upgrade or replace assets as technology advances or market demands change. Fourth is the preserving working capital. Working capital is the lifeblood of any businesses. Ensuring smooth day-to-day operations, lease financing allows businesses to preserve this crucial capital. Since there's no need for a hefty upfront payment when leasing an asset, companies can keep their working capital intact. This preserved capital can then be used for other operational needs, such as inventory, payroll, or marketing efforts. The fifth one is the predictable payments. Lease agreements typically come with fixed payments, offering predictability in financing planning. Your business can budget with confidence, knowing exactly how much you need to allocate for lease payments each month. This predictability eliminates financial surprise and allows for more accurate forecasting. The next one is about the disadvantage of lease financing. First, long-term cost implications. While lease financing might seem like a cost-effective solution initially, over the long term, we might end up paying more than the asset actual value. The cumulative effect of our monthly lease payments can sometimes exceed the cost of purchasing the asset outright. Second, no asset ownership. One of the significant drawbacks is that at the end of the lease term, you don't own the asset. You've been making payments, but the asset remains the property of the lessor. This can be limiting, especially if you've grown dependent on that particular asset for your business operations. Third, dependence on the lessor. With lease financing, you're inherently dependent on the lessor for the maintenance and upkeep of the assets. If they don't uphold their end of the bargain, it could disrupt your business operations. You're entrusting a part of your business functionality to an external party, which can sometimes be risky. The next one is about no capital appreciations. Assets like real estate or certain equipment can appreciate over time. When you opt for lease financing, you miss out on this potential capital appreciation. While you're using the asset, any increase in its value benefit the lessor, not you. The next one is potential for higher interest rates. Depending on the lessor and the terms of the agreement, you might find yourself facing higher interest rates compared to other financing options. This can increase the overall cost of leasing, making it a less economical choice for your business in certain scenarios.
Okay, for the next one is loan versus leasing. What are the differences between loan and lease? Loans and lease financing are both popular methods of funding, but there is a key distinction between the two. A loan is the borrowing of money, while a lease is a term rental agreement for the use of specific equipment. As a means of financing, loans and lease have different benefits. Understanding the difference between a loan and lease financing can help you decide on the best option for a business needs. Below are some of the major considerations to consider. The first is about the interest rate. Loan rates are usually floating and based on prime rate or another index such as LIBOR. As the index fluctuations, so does the monthly payment. This is beneficial during period of falling interest rate and determined when interest rate rise. Lease. Unless the lease has special provision, payments are generally fixed the term of the lease. Fixed payment make budgeting and cash flow management much easier. For the amount financed, the first is loan. Banks generally lend a portion for 60% to 80% of the equipment or vehicle costs, exclusive of soft costs such as shipping, training, installment, etc. For the lease, up to 100% financing is available, including soft costs and sales tax. In the part of extra costs, for the first is loan. Banks use to fees to boost their rates of return on loans, including application fee, origination fee, commitment fee, and etc. For lease, in 99% of small ticket equipment lease, there are no origination, commitment, or application fee. Depending on the transaction size, documentation fee are minimal, ranging from around $195 to $295.
The next one is the position in financial statements. In lease, the asset value is not included in the financial statement, whereas in the case of loan financing, the asset appears on the asset side, and the corresponding liability for loans appears on the liability side.
So what are the impact of lease accounting on financial statements? The impact of lease accounting on financial statement is substantial. These lease obligations have quantitative balance sheet impact. The standard enhances transparency, reduce off-balance sheet financing, and provide stakeholder with a more accurate portrayal of an organization's financial position. While the change may require adjustment in financial reporting and decision-making process, they ultimately contribute to a more informed and comprehensive understanding of an organization's financial health.
Why do companies prefer to lease rather than buy? Here are some of the biggest reasons why companies prefer to lease. First, you get more purchasing power. There are 100% financial options. And the second, you're not responsibility for maintenance and the repairs. The third, you get your items quickly. And the fourth, you get more purchasing power. And if you decide to lease something for your businesses, it can give you more freedom on the type of item you can afford. Paying monthly means you can get higher end equipment that you usually wouldn't have the money for otherwise. This means you have more purchasing power. The type of items you will be getting from leasing is often better, more functional, and more powerful than the items you could get from the owning outright. The primary advantage of the leasing business's equipment is that it allows you to acquire assets with minimal initial expenditures. Because equipment leases rarely require a down payment, you can obtain the goods you need without significantly affecting your cash flow.
How do you evaluate the impact of operating and financing leases on your financial ratio? For the first one, we need to know first what is operating lease. Operating lease is a type of lease that doesn't transfer the ownership or the risks and reward to the asset of the leases. The lease only pays for the use of the asset and return it all at the end of the lease term. Operating leases are treated as the expenses on the income statement and do not affect the balance sheet. Therefore, operating leases reduce your net income and reduce your operating cash flow, but they do not affect your asset, liability, or equity. Operating leases also improve for some of your financial ratios, such as a debt to equity ratio, financial ratio, and the return on asset ratio, because they lower your debt and increase your asset efficiency. That's all. And the second is financing lease. A financing lease is a type of lease that transfers the ownership or the risk and reward to the asset of the leaser. The leaser effectively purchases the asset and pays for it over time. Financing lease are treated as the asset and liability on the balance sheet and as interest and depreciation expense on the income statement. Therefore, financing leases increase your asset and liability and reduce your net income and for your operating cash flow. Financing lease also worsen some of your financial ratios, such as debt to equity ratio, the asset turnover ratio, and return on asset ratio, because they increase your debt and decrease your asset efficiency. The impact of lease according to accounting standard. In 2016, the Financial Accounting Standard Board (FASB) and the International Accounting Standard Board (IASB) issued the new lease accounting standard that requires leases to recognize more leases as assets and liabilities on the balance sheet. The new standard aims to provide more transparency and comparability for the user and financial statement. However, they also change the way of lease affect your financial ratio. Under the new standard, both operating and financing leases increase your asset and liabilities, but operating leases still have lower interest and depreciation expense than financial leases. Therefore, operating leases still have less impact on your net income and your operating cash flow rather than financing leases, but they have more impact on your balance sheet and ratio than before. How to evaluate the impact of leases on your financial ratio? To evaluate the impact of leases on your financial ratio, you need to understand how they affect your income statement, your balance sheet, and your cash flow statement. You also need to compare your ratio with those of your peers and industry benchmarker, as the different industry may have different leasing practice and preferences. You can use various tools such as ratio tool, trend analysis, such as common size analysis, and DuPont analysis. This tool can help you to identify the strength and weakness of your financial performance, liquidity, efficiency, and how they influenced by your leasing decision. And why it matters for your cash flow statement. Your cash flow statements show how your cash inflow and outflow are generated from your operating, investment, and financing activities. Your leasing decision can affect your cash flow statement in different ways depending on how they classified and reported. Operating lease reduce your operating cash flow, and they do not affect your investing or financing cash flow. Financing leases reduce your operating cash flow and increase your financing cash flow, but they may also affect your investing cash flow if you purchase or sell the lease asset. The new lease accounting standard also may change how you report your cash flow from leases, as you need to separate the financial and principal leases payment for both operating and financing leases. Therefore, you need to be more aware of lease, how affect your cash flow, and how they reflect your cash flow generation and management.
Yeah, Bobby Valentino.